February 12th, 2021. It's all-out mania in the stock markets. Meme stocks, SPACs, AMC, and Gamestop are the center of the world. Within all of this speculation, a new face representing these wild companies emerges out of nowhere. Cathy Wood. Her investment ETF, ARKK, better known as the ARK Innovation Fund, is a representation of the speculation occurring at that time. On that day, nearly 1 year ago, ARK found itself up about 320% from the pandemic lows just 8 months prior. Cathy Wood was now at the center of attention on Wall Street. But what happens next is both sad and sort of expected. Slowly, there was a rotation in the market. Although the S&P 500 continued to surge higher in 2021, ARK did the opposite. Since February, the ETF is down almost 51%. Cathy continues to insist that her fund is deeply undervalued, and in today's video, we break down her rather bizarre analysis. We start with her investment philosophy, which is practically the exact opposite of someone like Warren Buffett. Ms. Woods believes that innovation stocks are in, quote, deep value territory. This philosophy worked great until the markets decided that stocks like Zoom, Tesla, and Teladoc weren't exactly worth 460 times sales. What happened next was sad for Cathy's believers. The S&P 500 went up 16% while ARKK got demolished. And what does Cathy say about all this? We'll take a listen to this recent clip.
First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research.
Okay, so Cathy still maintains belief, and in this 47-minute interview she posted on her YouTube channel, she goes into detail on why she continues to believe. I'm going to break down the highlights for you in a more condensed format, and we start with her first blame. It's something you wouldn't expect from a fund manager, but it's worth a discussion nonetheless. She blames the start of the troubles back in February on algorithms. Her claim is that while most of Wall Street was focused on growth last year, that attitude has completely shifted. She states that large funds were looking at indicators like cash burn and cash cushion for analyzing what the next big growth players would be. This strategy is why so much money went into companies like Teladoc, Zoom, and Tesla. But this all ended when inflation became a massive threat and there was an attitude shift that compared the current environment to the environment of the late 90s. Basically, Wall Street and its algorithms decided that this was a massive bubble and began looking at momentum indicators instead. Once there was a sign of momentum ending, they moved all their money to value, thinking that the bubble would burst. But Cathy says that the bubble isn't real. She uses the case of drcoop.com to prove her point. This was a late 90s stock that made a splash when it raked in $88.5 million in its June 1999 IPO. It attracted the attention of AOL, and its stock price rose to $46 a share. By December of 2001, Dr. Coop was out of business, lasting a total of 2.5 years. This to her is an example of a true bubble, and right now she says, we don't have anything like this in the markets, therefore she claims that the Wall Street opinion is dead wrong. In fact, she was quoted saying, we are nowhere near that situation right now. On top of this, Cathy brings up some interesting points that her critics can't deny. First is the continued growth of the so-called stay-at-home stocks. These were companies like Teladoc and Zoom who soared on the news that we would be sheltering in place for a long period of time. Once those restrictions were lifted, most investors sold their holdings and the stock prices plummeted. But Cathy has evidence that this was a rather bizarre choice by many investors. Take for an example Zoom. Following the health crisis I can't speak of due to monetization, Zoom's revenue went up 370% in Q4 of last year. This was a massive move that resulted in the stock price soaring. In this year's Q4, Zoom is expected to post revenue growth of 19 to 20%, a showcase that it continues to blossom despite putting up an absurd number last year. This is true of many stay-at-home stocks like Teladoc, who posted similar numbers. Cathy's claim is that this is a clear sign that these stocks have been oversold as they continue to grow despite the stay-at-home narrative moving away from them. But what about her thoughts on the economy as a whole? There are plenty of people who think interest rate hikes are coming and we are doomed, and if the Fed doesn't raise them, we are doomed by inflation. A double-edged sword, a lose-lose scenario. Cathy has other ideas.
Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory.
This is where I start to lose all trust in Cathy. Despite being a renowned investor, her claim that inflation is indeed transitory is baffling and absurd. The word transitory is defined as not permanent, so technically speaking, everything is transitory. But realistically speaking, we've had high CPI prints for well over a year and a half now, and there are no signs of slowing down. That steak that now costs 40% more in your grocery store isn't going back to its old price just because Cathy thinks eventually the CPI will normalize. The damage has been done. Inflation wasn't transitory. Now the question is, how long will this period of extreme CPI last? According to Ms. Woods, it's only a matter of months. She uses this stat, the velocity of money, to make this claim. Her argument is that inflation is largely dependent on how fast money exchanges hands, and this indicator is slowing down despite the massive amounts of money printing occurring at the Federal Reserve. But despite this, there's no denying that many other indicators are pointing to a troubling future for US markets. Consumer sentiment numbers are down, retail sales adjusted for inflation were down, and real consumption is flat. All these stats are finally starting to tell the true story. Most of them have been highly manipulated or blurred by various forces to make them appear better than what they are. Take for an example GDP.
The other is, again, reflecting on third quarter GDP statistics. In the third quarter of last year, real GDP was up 2.3%. It was a big disappointment relative to expectations. But what the headlines did not feature, and still are not featuring, is that practically all of that growth went into inventories. It wasn't sold. Real final sales were up a tenth or maybe 0.2. So even in the third quarter, now remember, that's reaching back to June. Even in the third quarter, inventories were starting to build at a time when everyone was talking about supply chain problems. And I think what we were beginning to see is the consumer getting quite upset that necessities, the prices of necessities, were escalating and destroying purchasing power.
So what Cathy just said there reaffirms this bad news. Companies have built up large inventories, in turn pushing up GDP numbers, but much of those enlarged inventories have not sold, an indication that consumers are frustrated with new prices. Whatever the case may be, it seems that ARKK is in real trouble. Their flagship ETF is down 50%, and now with the market's biggest and strongest players coming down with it, the big question remains. Are the high-flying names like Zoom, Tesla, and Teladoc going to survive this incoming wave of normalization in the market? Thank you guys for watching. As always, don't forget to hit that like and subscribe button if you enjoyed it. And if you have some time, make sure you check out my other channel and follow me on Twitter. The links are in the description below.